Hey guys, welcome to another video by Fully Informed Trade, or FI Trade for short. My name is Alex, and I'm just going to go ahead and talk about the stock, the commodity, the bond, and the Forex market. So without further ado, let's go ahead and review the dollar index. And like I said before, the dollar index I felt found some support at around $79, and it continues its longer term uptrend. However, I feel a little bit uncomfortable now because this market has just touched its higher resistance level, or the midterm resistance level right here. And whether or not the commodity, the stock, the commodity markets particularly pull back hinges on the very dollar index you're looking at right now. The dollar index can break above this resistance level. More than likely, I anticipate commodities such as crude oil, gold, silver, corn, it doesn't really matter. Any type of commodity, or a vast majority of commodities, will pull back in response to a dollar breaking above its short to mid-term resistance level. Let's go ahead and look at a one-year chart to give you a basic idea that we are looking at a double top. And if we can break above, this will be a very, very positive indication for the markets. It's been able to find support at the $79 level many times, as you can already see in the past. And if you can break above this $81.30, give or take $81.20 resistance level, this market should be able to push higher into $82 to the $84 range. After all, I see resistance at around $83.50. That would be my next resistance target, and if we can break above this, this will be the next range we're going to be looking at, and it will probably try to find support every time it pulls back at around this same support level, or this resistance level we're looking at currently. Let's go ahead and review the stock markets. First of all, Dow Jones Industrial Average closed negative and had a negative 100-point day at first. People were skeptical. They wanted to get out of the markets. People were they wanted to take whatever they had and leave before the week would close. Short-term traders took the brunt of it. They pretty much said, hey, I'm going to be closing out my positions for the weekend. I don't want to take things over the week because I'm not sure how things were going to work out. The jobs data was a little bit mixed up. People aren't sure exactly what type of picture they're looking at. And because of that, you have somewhat of a market pullback, and it's not really surprising. And I'm going to go ahead and review the unemployment rate number that came out. But before that, let me just go ahead and review the basic markets. Dow Jones Industrial Average negative 0.19%, S&P 500 negative 0.18%, the Nasdaq Composite was negative 0.25%, New York Stock Exchange Composite negative 0.26%, the S&P 400 Midcap negative 0.25%, Russell 2000 negative 0.45%, S&P 600 Small Cap negative 0.48%. Alright, so without further ado, let's go ahead and review the employment situation. The unemployment rate fell by 0.4 percentage points to 9.4%. So basically, unemployment rate did go down, and non-farm payroll employment increased by 103,000. So it went from give or take 9.5 or 9.6% down to 9.4%, which is a pretty decent improvement, but not enough to convince Wall Street to keep buying into this market rally, or this earnings fueled rally. And because of that, a lot of people are starting to see that the year of 2011 might not be as great as what 2010 was. And because of that very main point, we shouldn't be holding on to stocks after earnings season, because we don't want to take on the risk of being disappointed or being caught up in a crowd of disappointed investors. Alright, without further ado, let's go ahead and review the gold market. The gold market went ahead and pulled back, and it continues its pullback, but it found somewhat of a support at around 1,360, and it's been able to find support at that level quite a few times. And if we go ahead and look back at the dollar index, that was the same time the dollar index Every time the gold market pulled back to that much of a degree, the dollar index, chances are, was at this resistance level as well. So how should we approach the gold market? Well, if gold were to find support, it would definitely require that the dollar index pull back from this double top. If it breaks above this resistance level, the gold market will most likely continue its downwards trend into the range that I was anticipating, which was basically 1,200 to around, give or take, around 1,300 to around 1,200, and the likelihood of us pulling all the way back to around 1,220 isn't really in the books yet. I don't really anticipate it, but as the market unfolds, we'll go ahead and see how things are going to go ahead and play out. Let's go ahead and review the silver market. Silver market, same exact story here. It continues its pullback as the dollar index continues a strong upwards rally. Because of that, I anticipate that the worst we're probably going to see is somewhere around give or take $26 to around $26.50 of a pullback, and at worst we can see something around $26 or $25 per ounce of silver. $24 is the next support level as well. But right now, I anticipate at most, if we're going to have a 10% pullback, that would push us right back down to around the $26 to around the $24 range. Below $24, I don't really anticipate much of a pullback. On today's trading session, let's go ahead and review what happened to the silver market. At around 8 a.m. onwards, it went up substantially enough to around $29.30. Let's go ahead and review what happened in the dollar market. At around 8 a.m. onwards, the dollar market had somewhat of a pullback, and then it started rallying. Then it had the same pullback, and it became very volatile. But overall, from around 11 a.m. onwards, that's when the dollar market continued its upwards rally. And from around 11 a.m. onwards, that's when the silver market finally gave wind and decided to pull back. So that's pretty much what happened in the silver markets. Let's go ahead and review the bond market. The bond market, longer term, yes, it has been able to push up back a bit, and that's because of investors, like I was saying earlier, people going back into the risk-free rate, low-risk trade, or just being able to flee the stock market from certain names like the retail sector. They go off and take that money and they go off and put it in bonds because they know that bonds will produce them a decent enough of a return, a risk-free rate, a rate of return that they can always rely upon. And because of that, it causes this dynamic of a bond market rally in proportion to a stock market, in proportion to the stock market pulling back. Let's go ahead and review the next symbol, which is going to be the crude minis for February 2011. First of all, crude oil did have it's been able to find somewhat of a support above this Bollinger bottom deviation. But because of that, you got to realize that overall, this trend is somewhat negative. Even so, if we go ahead and put up a daily triangle, it indicated a negative trend at around $89.50. So overall, short term, the trend is negative. The dollar continues higher and breaks its resistance level. You could easily anticipate this market going below going below this Bollinger Band and having the Bollinger Band trail lower as the markets continue to have its minor correction in commodities. Let's go ahead and review the volatility index. Volatility index, it started off very weak, and the main reason why it started off weak, if we go ahead and zoom back into the Dow Jones Industrial, at around at the very beginning of the day, the Dow Jones Industrial was positive, and because of that, people in the volatility index decided to go ahead and sell their position or stake inside of it. If you could go ahead and see, it started off just negative. It just collapsed right there at around $35.20, but then it continues higher as the Dow Jones goes ahead and starts pulling back by around 100 points, and then it closes negative on the day. So pretty much Fridays generally aren't positive days. I anticipate that the markets either they start selling off before earnings season or they start a major sell-off after earnings have already been announced. We're going to have to wait and see. Overall, I don't feel too positive on the stock market right now. This earnings field rally is trying to get a little bloated. It's getting a little frothy up there. Because of that, we're going to have somewhat of a pullback. Let's go ahead and review Bank of America. This is another stock I mentioned that I don't feel too comfortable recommending anybody to buy it now at this point, because it's already hit its major it's already been able to go up substantially enough as it is by around 40%. I felt that pushing it any further was risky, and that if you did buy into it and if you don't want to sell it, then you could always hedge your positions by buying the FAZ, or you could buy Bank of America put options. And for all of you guys out there who have stocks that you guys have already sold, you guys got plenty of options. You could always buy into bonds. You could buy into low risk, high yield type of dividend investments, like I was mentioning, Campbell Soup, Procter and Gamble, stuff like that. Or you can just buy put options. If you're a speculator, you'd you'd either be buying up shorts, you'd be buying up volatility index, you would be buying up FAZ, and that's just because you're bearish on the markets. But overall, from my experience, anytime an earnings field rally, every earnings field rally has somewhat of a pullback, and because of that, we should try to profit off it. Anyway, to use the same charting software that I go ahead and use, please be sure to check out the link above or below this video. It should be above the video if it's on Facebook, and it should be below the video if it's on YouTube. Anyway, without further ado, that's all for today, guys. Please be sure to keep on checking out my videos. Your support does help. Take care, folks, and I'll see you guys next time. Bye.